Hello and welcome to the Global View on this Tuesday. I'm Andrew Gagan. Thanks for joining us again here at Ausbiz. Let's get across what happened overnight. A relief rally on global equity markets after President Trump postponed a threat to bomb Iran's power grid because of what he described as productive talks with Iran. But Iranian officials have dismissed that as fake news. President Trump's decision saw oil prices plunge more than 10%, buoying investor sentiment as the so-called taco trade played out on Wall Street. The volatility index retreating after earlier hitting its highest level in 2 weeks. Airline and travel stocks benefited as the price of oil fell. Likewise, shares in cruise ship operators. And the banks, which had weakened during the conflict, gained ground, with the S&P 500 banking index showing its biggest daily gain since before the war began. Tesla shares accelerated after Chief Executive Elon Musk said the EV maker and SpaceX will build 2 advanced chip factories in Austin, Texas. Palantir Technologies climbed on news that the Pentagon will lock in long-term use and funding for the company's weapons targeting technology across the US military. Synopsys shares surged after activist investor Elliott Investment revealed it has a multi-billion-dollar investment in the electronic design automation firm. And US-listed shares of Rio Tinto and BHP tracked the copper price higher. Well, Iran has denied that it's been negotiating with the United States after President Trump postponed a threat to bomb Iran's power grid because of what he described as productive talks with Iranian officials. He said, "We've had very, very strong talks. We'll see where they lead. We have major points of agreement. I would say almost all points of agreement." The European officials said that while there had been no direct negotiations between the two nations, Egypt, Pakistan and Gulf states were relaying messages. In a statement, Iran's parliament speaker said no negotiations have been held with the US, and fake news is used to manipulate the financial and oil markets and escape the quagmire in which the US and Israel are trapped. The US Treasury yields retreated from multi-month highs after President Trump said he had ordered a 5-day pause on all strikes against Iranian power plants and energy infrastructure. The US 2-year Treasury yield fell to 3.79%, the 10-year lower at 4.3%. The Australian 3-year government bond yields fell to 4.69%, the 10-year down to 5.03%. The US dollar index was down around 0.5% on the day, the Aussie trading at 70.2 US cents. Well, oil prices dropped about 11% after President Trump chose to de-escalate the conflict with Iran. Crude futures plunging almost 15% earlier in the session, but pared some of those losses after Iran said it had launched new attacks on Israel and other sites in the Middle East and denied that Tehran had engaged in negotiations with the US. Brent futures around 11% lower, settling at close to $100 a barrel. Gold trimmed losses to recover from a 4-month low. Spot gold down close to 2% at around $4,400 an ounce. Copper rebounded more than 2%. Iron ore little changed at 111 US a ton, and Bitcoin is just under 71,000 US dollars. So let's get across those market moves. Steve Sosnick is the Chief Market Strategist at Interactive Brokers. He joins again now. Steve, welcome back. So is it fair to say perhaps Donald Trump has his eyes firmly fixed on the stock market, opinion polls, and less so the war at this point?
Good morning, Andrew. Yeah, it's clear that something else motivated him besides just progress in the Middle East, because we've had a series of contradictory goals thrown at us as to what constitutes success in this conflict. It's not clear that they've been met necessarily, but what we saw overnight was overnight your time, and actually for early in the morning our time, was I'm going to call it a retreat. What I've preferred to focus it on, just because it's less politically driven, is I called it the Trump put. Analogous to the Fed put, where people assume that the Fed or other central banks will come to a market's rescue when it needs it. The thought would be that Trump would do the same. But my question, literally on Friday, a piece I wrote on Friday, if you go to IBKR Campus and Traders Insight and search for it, you'll see I wrote 2 pieces. What's the strike price on the Fed put? And then today was, okay, now we know what the strike price on the Fed put is. And that was apparently somewhere around 6,500 on the S&P 500, or 445 or so on the 10-year. I actually think it might be a bit more of a fixed income put, considering that the president comes from a real estate background. He spends a lot of time with other real estate people, all of whom are focused on borrowing money or selling or selling real estate to people who borrow money. But regardless, it did seem like I'm not going to use capitulation necessarily, but a change in strategy to mollify markets.
Given the capricious nature of Donald Trump, how concerned should we, I guess, not getting ahead? I mean, you got ahead of the game. Obviously, was talking about late last week, talking about this is likely to play out. But given these rallies, just how cautious should you be, do you think?
Here's the problem. I think a lot of people are using the Liberation Day playbook where, basically the market sold off partially because they hated the idea of the tariffs and that they were not necessarily on anybody's agenda for first things that the president could do. But I think really what got markets down in the dumps at first and then caused them to rally later was at first he seemed tone deaf about the market falling. And that was freaking people out because in his first administration, say what you will about the man, he was very much focused on markets as a barometer for his economic performance. Then when bond markets, quote unquote, got literally, quote, was yippy in April, that was when he turned around, got rid of the worst of the tariff policies. By the way, not all of them, but it was enough to get markets okay with what was going on. Similar idea here. The problem is tariffs can be implemented or withdrawn at the stroke of a pen. Makes them very capricious, but it's different than starting a war that involves global oil supplies. That's not so easy to just turn the switch in the other direction. There are still tankers stuck in the Straits of Hormuz. If it's a 5-day ceasefire, are they going to be incentivized to start moving through the straits? If so, what are the insurance rates on those tankers? I'll guarantee you, I know nothing about insurance on tankers per se, but I guarantee you it will not be what it was before. You've also eliminated a fair amount of production capability in some of the regions. It's estimated that Qatar's gas fields, it's going to take 3 to 5 years to rebuild them. So you're not going to see this quick rebound in energy prices the same way you saw things turn around after the tariffs. And that's going to have lasting effects. Maybe not as bad as if these were prolonged, if there's just a prolonged conflict. But again, 5 days, what is that buying us right now? We need something a bit more concrete, and we certainly need a bit more, we just need more clarity going forward. And even then, it's going to take some time. I don't see oil prices going back to the called $60 a barrel level just because the president changed his mind today.
Well, given those lasting effects you're talking about there, Steve, how do you regard how oil traders are pricing this at the moment?
Well, I think they were right to pull back some of their gains. It had gotten very speculative. Just basically commodity trading is no different than anything else, as we've learned. In terms of getting a little bit manic from time to time. We've seen it in precious metals this year. So oil did have a certain amount of speculation involved, but I do trust oil traders when it comes to this overall because they're singularly focused on events that affect the supply and demand of their preferred commodity. And so the fact that oil came off, 15% was a bit much, call it 10% seems about right under the circumstances. But as you noted at the top of the segment, that means we're at $100 Brent right now. That's still, call it 40% above where we were when this whole thing started less than a month ago. So it's going to take some time to work its way out. And you could see today from the way the futures reacted pre-market U.S. time was as soon as basically it was within a couple of seconds. You could see they were following oil very quickly. So I'm still taking my lead from oil. Secondarily, I'll take it from fixed income markets, but those are really the keys to driving stocks right now, which, by the way, remain in a bit of a downtrend. The downtrends were not broken. We didn't get above the 200-day moving average on S&P 500 in any meaningful way. So stocks still have some work to do as well.
So, Steve, Where do you find a safe haven at the moment? Clearly bonds and precious metals not working for you. Is it cash?
Yeah, I mean, right now, cash, because you're not looking at, basically there is no central bank in the world right now that is poised to cut rates. So therefore, you're earning what you're earning on cash. You obviously live in your central bank obviously raised rates. It's not so clear that other central banks are going to be so quick to do that. But remember, we went from two plus rate cuts priced in for 2026 to zero right now. We were pricing in, call it 50% chance of a hike in 2026. That pulled back. But you know what? Right now, one of the paradigms that I look for is if short-term fixed income is extraordinarily volatile, and we're seeing about as much volatility in two-year notes as we've seen in quite some time, that means how are you going to, if you can't price stable items, how do you price riskier items? It becomes very tricky. Cash right now is earning you something. You're getting at least paid something to wait. Although I got to say, if inflation kicks up, in real terms, it's not what it was even a couple of weeks ago.
Steve, great to get across all those market moves. Thanks for joining us from Interactive Brokers.
My pleasure as always, Andrew. See you soon.
So let's turn our attention to the local market. Given that rally we saw on global equity markets, well, similar moves here, in fact, perhaps more pronounced. S&P ASX 200 futures up 1.8%, more than wiping out those losses we saw yesterday, and then some. We'll see if that actually pans out as we get underway. In just a couple of minutes, join us for the Open.